Good evening, everyone. Today is Wednesday, Fed Day, March the 19th, 2025. And I am going to cover what happened today and what I think might be coming up as well. Um, Hang on one second. Sorry about that. I just hooked up my microphone, so I'm not sure if it's going to make a difference, but hopefully you can still hear me. Anyway, today is Fed Day. Fed did nothing, which is exactly what I said they probably would do. In fact, if they had done either a raise or a cut, I think the market would have hated that. The market seemed to like it, at least at the end of the day. Now, we have to wait to see what the reaction is because many times the reaction the next day could be the opposite of what happened during the Fed meeting. But we still have options expiration happening on Friday, and I covered what usually happens on options expiration on Monday. So if you want to go back and review that video, Monday, the one that I did Monday on Max Payne, the market I think should continue to go up. It did pull back a little bit at the end of the day today, though. So we'll see what happens tomorrow. So let's jump into it and see what's happening. As always, I am not a financial advisor. So anything I say is not a recommendation to buy or sell anything. You have to do your own due diligence. So let's take a look at where we're at. On the home page, you can see on the market bias kind of went sideways again today. Didn't have a big move. And it actually is going to take a while to get a big, if we are going to recover, it will take a little while to get a big move to the upside. And I'll show you why that is. This is the market bias page. The market bias is made up of indexes, sectors, industry groups, intermarket relationships, commodities, metals, and currencies. And these are viewed on a short-term, medium-term, and long-term basis. And it shows you the percentage of bullish or bearish, but actually the percentage of bullishness in each of the columns. And you can see the first two are red. So not too many bulls. So today you can see there's one bull, there's one bear, two bulls. That was it. That's all that was added today. Actually, two bears. So kind of a split day today, but they're in different columns. So the one way you can look at this is look at the short term as it's moving higher. It's crossed over the medium term now, so that is good. However, it's going to take a while to really get moving. So I'm going to look at the first couple and you'll see what I mean. So in order to get a short-term up signal, the 5-day moving average, the pink one here, has to cross above the 21-day. We have had such a huge downtrend that the moving averages naturally have moved a long way away from each other. So in order to get that short-term signal, it will take quite a while to get back up there to the 21-day. And that's true of most everything, especially on the major indexes. There's the NASDAQ, there's the Dow, there's NASDAQ 100. So you can see it probably is going to take the rest of next week for continued bullishness to even get some short-term signals. But if we do get that, once we do get those signals, they're going to come pretty quickly and they're going to come in batches too. So if and when the market recovers and we start to move higher, this will move up very, very quickly. But it's going to take some time to get there. And what I'll talk about tonight is whether I think we've hit the bottom or will there be more ahead. Now, for those that have been tuning into this channel for a while, know what my answer is going to be, I think, on that. I think on the short term, yes. But on the longer term, I think there's more downside to come. So let's jump into it and take a look at some of these things. What I'm going to do tonight is take a look at the daily routine. So actually, I'll go back and look at the other indexes real quick, since I always do that. So here's the S&P. S&P right there, you can see it went up, pulled back a little bit at the end of the day. Not really a convincing move, though. I mean, this is not the kind of move I would like to see. The volume is below average, pull back at the end of the day. I'd rather see it move higher at the end of the day, but that's not what it did. Now, the momentum is crossing over, so this might give us the enough of a push in the short term to get up, as I have said repeatedly, back probably somewhere between the 21 and the 50-day moving average, somewhere back in this area, 58.50 most likely. But if we even can make it there, we shall see. And then the NASDAQ 100 is on this chart right here. You don't need a subscription to look at these. Anyone can come on here and take a look at these charts. So there's the NASDAQ. It looks the same. Pull back at the end of the day. Not really convincing. Volume was lower, but momentum is starting to cross. So we might still have enough to push us a little bit higher. And Bitcoin, of course, also had a nice day. Actually had a really good day. It's right at the 21 day. So that's a key decision point. I suspect it probably will push through. It was on very low volume. And you can see this little sideways move here was on extremely low volume. Bitcoin, of course, trades 24/7. So one question that somebody asked was, does the fact that it trades 24/7 affect the charts? And not really. You just have to be aware of it. So on these really, really low volume days down here, that's Saturday and Sunday. So it's going to actually show you candles. That's Saturday and Sunday. This was Friday back here. These two were Saturday and Sunday, really, really low volume. But even Monday and Tuesday were low volume too. You can see there's a bigger candle on those 2 days, but the low volume is just low liquidity. That's all. But it doesn't affect anything with the chart and how the chart will give you an indication of what might happen. Today was a good day. It ended near the high, so that was good for Bitcoin. All right, let's jump back over here, and I'm going to do the daily routine. Just go through some of these. So I have this daily routine right here. The first one is the market cycles. I've showed this before. This is basically Dow theory. This is how markets typically work. There's an accumulation phase. This was back in October of 23. That was the start of this bull market. There's a markup phase, a reaccumulation where it goes sideways, markup, reaccumulation. Then it gets to a distribution phase. And I've been talking about this for a few weeks now, that I thought it was in the distribution phase. And at some point, it was going to break through the support level, which is at 58.50. And it did that back here in beginning of actually middle of February. Actually, they broke through in the beginning of March and then continued to go down, went below the 200-day moving average, went below all of these Fibonacci levels right there. So blew through that one, but it did find support at this one. So that's the 50% Fibonacci level. And I've had these arrows on here for a while as well. Before it even got here, I said what I think will happen is that it will bounce. It will go back and test the support level, which is now resistance. It has to get through the 200 and the 21, which are almost at the same place right now. So the 200 is at about 57.50, and the 21 is at 57.65, and it's declining. So it needs to get through that. If it can do that by the end of this week, then I think we might have a chance to go a little bit higher, up to 58.50. But that's the real question mark. Can it get through that key resistance level? So it's sitting right here at this Fibonacci, two Fibonacci levels right there that it needs to get through. So there's lots of resistance, overhead, all kinds of resistance here that it has to finally break through. So we need to keep an eye on that. But that's what that looks like right now. If we look at I'm going to use the NASDAQ 100 for these. Weekly trend analysis. As you can see down here, I was watching the medium term, comparing it to 2021, which was a bear market for almost the whole year. It went below the 21-day right there, and at the same time that the medium-term trend went below zero. So those two right there is what I was watching for. And you can see it went below zero there and went below the 21, almost on cue, just like 21, or 22 rather. So the beginning of this is January of 22. So this is March of 25. So we're about 2 months, probably 5 or 6 weeks behind the time frames from 22. So just keep that in mind. And then over here, we went below the 50-day. It's this red dash line, went below the 50-day. It kind of went sideways a little bit with red bars. And right now we went below the 50-day, and now we have one red bar. So let's see what happens now. In this case, it tried to get back, kind of made it back to the 21-day. That's what I'm watching next to see if we get back to that 21-day. And then you can see what happened. It then went down a little bit lower and then bounced up. And everyone thought that it was over. We're heading back to all-time highs, but we weren't. And it went down again. And I think we're going to do something similar this time. So you can see how closely this reflects what happened in 22. And one thing that's a little different is the money flow. This is a quarterly and an annual money flow. So the darker one is a quarterly money flow, and the lighter one is the annual. Actually, I take that back. The darker one is a monthly money flow. It's 13 weeks. So that is quarterly. And then the 65, no, this is a daily. No, this is a weekly. So that's 13 weeks. Yeah. So this is more quarterly and annual. So this is a little different from over here. In this case, money flow actually went below zero. In this case, it bounced back. So that means Wall Street is getting back in, taking advantage of the lows right now, and starting to buy some stocks. So we'll see if that continues. All right, let's look at the next one, the big picture. We'll look at it on the daily, and this is the bearish wedge that I talked about for quite a while. Broke through it right here. They usually break to the downside, and that's when this one did. And you can see again, the 21 and the 200 are right together. So it needs to get through both of those and try to get back up to that 58.50 level. This is actually the NASDAQ 100, so it's 21,000 on this one. So again, we're starting to make a little recovery, but I don't think it is the end of the downtrend, frankly. If we look at the Keltner charts, this is essentially an extreme. And usually when charts get to an extreme like this, so the green one in the middle is one average range, the distance it usually travels in one day. So the blue one is 2 times the average range, and the red one is 3 times the average range. Whenever it gets to an extreme in the 3x, or especially in the 4x, it usually doesn't stay there very long and reverts back to the mean, comes back to the 21. And that's what it's in the process of doing right now. You can see there's not really a lot of conviction in the move today. Even though the market liked what they heard from Powell, from the Fed, there really was not a lot of conviction. I would have expected this to be a much bigger candle and even possibly a green candle, but it still stayed blue, which is a neutral candle. Red means both the trend and the momentum is down. Green means both trend and momentum are up. And the blue just means neutral. One of those two is different. So in this case, it's not giving any real confidence or confirmation that we're going to have a huge rally. You know, to really get back into an uptrend, we have to go take out these highs way back here. So I think we're going to go up and then come back down again. That's my opinion. All right, that's the Keltner. Let's look at the 10-minute charts. These are interesting because you can see right here, here's the open for today. So this is from this vertical blue line is Monday, the beginning of the week. And the horizontal blue line is Monday's open right there. And you can see today we started moving higher. Yesterday was just treading water, waiting for the Fed. This morning we moved higher a little bit, then kind of went sideways, and then the Fed meeting happened. And we blew higher after the Fed meeting, especially once Powell started talking, which was at about 2:30 right here. Went up until about 3 o'clock when he stopped speaking, and then it pulled back. Now, that in and of itself is not too alarming because they usually have pullbacks when you have a big run higher. So we're going to have to see what the reaction tomorrow will be. And technology has been outperformed for the week, but moved higher. Financial moved higher. Discretionary went down. Communication services went down for the week, and industrials went up. So these are the aggressive sectors. So that's what it looked like during the day today. Now let's take a look at breadth analysis. This is just the breadth of the market, the advanced decline line. So you can see as the market was coming down, naturally, there were more decliners. As the market has had this little rally, there are more advancers. So the advanced decline line actually is looking okay. Large cap advanced decline is looking okay as well. But mid cap and small cap are, even though they're recovering, they're still pretty depressed. They're still pretty far down. So I would say breadth looks like it should for a small rally like that, but it has a long way to go to get back to the previous highs. So again, not convincing. Let's look at the McClellan oscillators. This basically is a moving average of the advanced decline lines. And again, you can see the advancers. It's now above zero, so there are more advancers than there are decliners. It had been the opposite. So, but this is not really a strong rally right here. And the bullish percent index for the NASDAQ 100 isn't even back to halfway yet. So again, not a lot of conviction in the move. We'll see what happens tomorrow and the rest of the week. And then sentiment on the VIX did go below 20, but barely. 19.9. Below 20 and above 17 is in the neutral zone. And you can see it's been coming down for over a week, even as the market continued to move lower. The VIX has actually moved lower too. So, and the 12-month rate of change is going down. So that shows that the market isn't overly concerned, but it's still not in bullish territory. Below 17 is bullish territory. So again, really not giving much conviction of what's going on. Let's look at the 5-day put call ratio. This is the puts versus the calls. If it's going up, there are more puts, which means more people are bearish. When it gets up to a very high level, like it did back here, that usually is where reversals occur. So you can see the S&P is the blue line. It's a 5-day moving average, the S&P. You can see it went to a low right there, and this went above the 72, actually the 75 level. Right here, the S&P went very low, and this was above the 75 level. Even as the S&P has hit a low this time, it has not really convincingly showed that a bottom is in. So we need capitulation. We need people to say, I am done with this market. It's just going to keep going down. I'm going to buy more puts. We need people to be a lot more bearish than they are, essentially. And you can see just the last week, the market started to rally on Friday. So there's today, Tuesday, Monday, Friday. So most of this week, there have been more calls instead of puts. So people are getting more bullish instead of bearish. In order for us to hit a bottom, we need this to be really bearish. There's the VIX that I just talked about, and then the 12-month moving average, 12-month rate of change, for the VIX, you can see is continuing to go down. So good news for the short-term rally, but bad news that I don't think we've hit bottom yet. We look at the 10-day put call ratio, kind of the same thing. We want to be up here above this 75 line, like we were here, like we were here, like we were here. Just barely hit it right there. That's where bottoms happen. We are not even close. We're barely halfway up there. So this is telling me we have more downside left. People are not bearish enough. We need everyone to really, we need it to get to the point where there are no more bulls left, and there are so many bears that there's nobody left to sell, essentially. And then we're not there yet. We've got a ways to go. All right, let's take a look at the risk on, risk off chart. This one was interesting. So this is telling you whether Wall Street is risk on or risk off. You can see the little bounce for the S&P right there, and you can see the momentum starting to move up. But junk bonds versus 20-year treasuries is still going down. It hasn't really broken the trend. Junk bonds versus high yield corporates. So when the market is in a very risky mode, they're going to buy more junk bonds and fewer high yield corporate bonds. But when they are less risky, they will do the opposite. And you can see this one's actually gone down. High yield corporate bonds versus 7 to 10-year treasuries, that one actually is starting to move a little bit higher. Growth versus value has not broken the trend yet, but started to tick up along with the rally. And then discretionary versus staples, also not convincing, but it is starting to move sideways. So this is things that people would like to buy, like going out to dinner, taking vacations, buying a new TV, a new car, and things people have to buy, like toilet paper and toothpaste. So that ratio, that relationship tells you what the overall mood of the market is. When it's going up like it did back here, then that confirms at the bullish trend, just like the S&P did. When it goes the other way, that means consumers are pulling back and they're not buying the discretionary items. They're putting their money towards the staples instead. So that implies that Wall Street is rotating out of aggressive and into the defensive areas. And even though we've had a little rally, there's nothing that's really convincing about that. Let's take a look at the 50-day and the 200-day. So here's the downtrend. Here's the little rally right there. I have the volume under here now as well. And you can see volume today was not even above average. The last 3 days was even lower. So there's really not very convincing in this move, this little move higher. There's the put call ratio pulling back. So more calls, more bullishness. Here's the percent of stocks above the 20-day moving average. I like to see that below 10. So you can see back here, it was below 10 and we hit a low right there. This one here actually came down, but it didn't really get below 10. But I want to see also on the 50, I want to see that below 20. We hit it right there, and that was the bottom right there. On the percentage of stocks above the 200-day, I like to see that at 30. We didn't even get close to that. And in the bullish percent index, we did hit the reversal area briefly, but we're starting to move higher again. So once again, I think the rally may continue at least for the rest of this week and probably into the beginning of next week, Monday and Tuesday. And then we'll have to see what happens. So we're, again, looking at that 21 and 200, and then finally the 50 way up here. And I'll continue to look at these as we move along through the week. All right, let's take a look at, I'm going to take a look at the daily scans. I ran a scan today. This is because we did get a little rally, so I figured we probably have some stocks that are just beginning to move. And this is a 5-day crossing the 21. And actually, the way this scan is set up, it actually identifies them just before, usually 1 day before the 5 actually crosses the 21. And I'm using ACP, the advanced charting program from Stock Charts. I mentioned this yesterday, I think, and somebody asked why I choose this, why I switch back and forth. One of the things I like about this is putting charts side by side like I have right here. So what I have is the daily chart in the upper left. I have the Keltner channels to tell me whether it's at an extreme or not. Now, because of the scan, so it's stocks that are getting back to the 21, none of them should be at an extreme. They all should be in the middle. The one on the right is at 30 minutes, so I can see what it did during the day. The one lower left is the monthly, so I can look at a very long-term view. And the one next to that is the weekly. So that's one thing I like about ACP. What I learned yesterday, I said I was having trouble syncing these up. In addition to setting up the layout and clicking the button that says sync all these together, meaning if I put a symbol in for one, it will have the same symbol for all. But I also found out that there is a button up here that toggles the symbol sync on and off. And that's what I wasn't doing yesterday. I wasn't looking at that little button. So if I have the sync button turned off, then it's only going to change one chart. It's not going to change them all. So let's take a look at some of these that appeared. So here's AMD. You notice on the daily chart over here, the other thing I like is you can blow out these charts and look at them more closely. So there's AMD. You can see right there the 5 getting ready to cross the 21. Again, the way I have this set up is basically one day before it crosses. So momentum's moving up. So that looks pretty good. If you draw an imaginary line across these tops, you'll see that it's just breaking out of that downtrend. So that's positive. If we look at the monthly just shows kind of moving kind of sideways, but it really hasn't broken down significantly. It made it back here down to, let me turn this on, down to $60. So we're sitting at 100 right now. So that's pretty much where this support level is on the monthly chart. So that's actually good news. That means it could continue to rally up, but notice it's got the 50 and the 21 that it has to get through as well. And then on the weekly, if we blow that one out, the weekly looks similar, big downtrend. And then today, of course, the week hasn't finished yet, but last week had a hammer, which implies a reversal. And this week is starting to move up, but not convincingly as all of these. So I'm just going to run down. You can see the names over here and you'll recognize a lot of them. So a lot of the big names are getting something similar today, getting that rally on the individual charts. You can just keep an eye on the daily over here, and you can see that what happened during the day today, actually for the week. So it goes back to the 10th. And then most importantly on the weekly right below, you can see the weekly still has a lot of work to do, but it is starting to break out. So Boston Scientific, it's curving up, starting to move. By the way, on the one thing that I do now on the Keltner channels is I put what's called a zigzag line in, and that helps me identify whether it's giving me a higher high and a higher low, or if it's starting to put in a lower low and a lower high. Which you see here, it has done that. So this confirms that it's in a downtrend. In order for it to break out of that downtrend, it's going to have to get above this previous high right here. It's going to have to make a new higher high. It doesn't necessarily have to get above this one yet, but it does have to get above this one. Otherwise, it is still in a downtrend. So if you just glance at that zigzag to see what it looks like, you can get a good sense of whether these charts, even though they're starting to move, how much more they have to go. Here's CrowdStrike. Long way to go here, but starting to move. It's participating in the rally. DoorDash, curving up. eBay, so you should recognize most of these symbols. IBM is moving. So a lot of these, IBM actually looks really good because it didn't really pull back as much as most of the other ones. And you can see over here, it actually did make a higher high right there. It also made a lower low. So it's going to need to go take this out, but it actually held up better than most of the other ones. And you can see the monthly over here, just continuing to go higher. Netflix is on there. There's what Netflix looks like. Palo Alto, Pulte Group. So all of these for short term look at Pulte over here. I mean, it's really clear. It's putting in lower lows and lower highs. So it's going to have to get above this 111, 112 area before it's confirming it's back in an uptrend again. Workday, and then we have some sectors down here as well. So material sector is on the list today. So it's trying to make a comeback. The financial sector, and again, this one is hanging in there. It's holding up back over here. It didn't go down below its previous lows. So it might be ready to move higher. Industrials, another sector that's starting to move up. So that's what the daily scan looks like. So let me put in one here that I had a couple that people asked me about. One is ASTS. So ASTS, you can see that it's actually held in pretty well. This is one that has been on my top 10 list consistently. We look at the daily chart on this. You see it's had a hammer today, sitting right on the 50-day moving average. Had good volume, but a lot of that volume might have been, we'll look at what happened during the day. A lot of that volume may have been at the end of the day. It's in a squeeze, but the squeeze has not fired to the upside yet. So I'd be careful with that, because even though it's in a squeeze, the momentum is still going down. Even today, it's still going down even more. And it looks like the red, think of these as the bears, and the green one think of as the bulls. So right now, the bulls and the bears are duking it out. They're equal to each other right now. So if that crosses over, that means you have more bears than bulls. If I look at this on the 30-minute chart, you can see, looks like, so this is, let's see where today started. Today started there. So it went down, looks like it put in a low right there, and then it started coming back at the end of the day. So it had a nice recovery, along with the rest of the market, had a nice recovery at the end of the day. So this one looks okay. It's not one that I think I would get in yet. If you're looking to take a position, if you're already holding a position, I wouldn't do anything, but I'd keep an eye on it. It's sitting right on support at $24 right now, and it's at $25.65. Closed the day. All right, the other one was GLPI, which I don't recognize. Oh, gaming and leisure properties. Okay. This one looks good. This one looks great, especially with the sell-off. You can see on the daily chart, it just keeps moving higher. So it's really had a really strong run, even as the market has sold off. I'm going to look at something else with gaming here in a minute. You can see here on the zigzag, you can see higher high right there. It needs to put in another higher high, but it's got a higher low too. So it needs to go up here and put in something above the 51, probably around 52. But it actually looks probably like the best one that I've seen today, best stock that I've seen today. All right, I had another question from somebody, and I'm going to use AMD for this. And they said, what do we do? How do we avoid the falling knife? So let's look at this on actually, you know what I'm going to do? I'm going to go to the regular version of stock charts and show this, because I have a chart style over here that actually shows if it looks more like a falling knife. So I'm going to make a couple of comments about this. The question is, how do we avoid the falling knife? And how do we know when it's done falling? Well, first of all, to avoid it, you look at the moving averages and look at all the things that I teach in my Technical Tuesdays, which I've got about 3 or 4 months worth now. There's a playlist on my channel, and you can go back and look at all of those. And so just understanding, I'm going to put in a 5-day moving average here too. Understanding technical analysis, which basically is a visual representation of market psychology. So when the 5-day, which is faster, moves below the 21, that's your first warning sign. You could have got out as that big red bar. You could have said, that's it. That's a big, huge red bar, and I'm out. So you would have avoided all of this falling knife. Or you could wait for the 21 to cross the 50. So there's 2 warning signs and got out there. Or you could wait for the 50 to cross the 200. Now, when that happened, this is starting to come back again. So if you didn't get out on these two, this one would just be a warning. And at this point, it's already making a move back higher. So you take a look. I'll actually show you this. So that's where it crossed right there. So you can see where the price is. It's already making a move higher. So the thing to do then is to wait and watch and see if it gets through that 200, which it didn't, got rejected. Did it again, got a little bit above the 200, got rejected. All right, so now it is making higher highs and higher lows, but it's not making a higher high to this one back here. So when it started moving down again, and then again, tried to get above the 200 and got rejected again, these are multiple warnings through all this period right here that probably you might want to get out of this stock, showing real weakness even during a time when the market was going higher. This is back in October, November timeframe. So those were the points to get out. So that's the first step for avoiding the falling knife. Don't even be in when the knife starts falling. But when it does start to fall, you'll notice it goes down and then bounces and comes back. In this case, to the 21, went down, 21, 21, 21, 21. It's actually gone through the 21 today, so it might have a little bit of life. But if you missed all of these signals, as soon as it comes back to the 21 right there, get out right there. So that's one way to avoid the falling knife. And if you're still in it, or let's say you're looking at it and want to make an entry and you can see that it's been a falling knife, but you're not participating, you're not losing money, but you want to take a chance to get in, but you don't know when the knife is stopped falling yet. Well, on something that's so clear as this, just draw a trend line across the highs. As many touch points as you can across the highs right there. So right there, no, it didn't quite touch, but you've got one there, one there, one there, one there. And today it broke through and it went above the 21-day moving average. So if you wanted to take a chance, you could take a partial position. And if you watched my video last night on position sizing and risk management, this would be a perfect opportunity to take a partial, maybe a half or even a third of a position and make it prove itself. So it needs to get through the 50-day. It's going to most likely pull back at the 50 and make a higher low, higher low. And when it does that and starts to go up again, then add another third. And then when it finally gets through that 50 convincingly and keeps going up, then I would just wait and see what it does, because at some point it's got a lot of resistance to get through. All these people just want to get out at break even. So in all of those areas, all of these people here just want to break even. Just let me break even. Please, God, just let me break even. Right here, I want to break even. So that's what I mean by overhead resistance. These are all the people that bought at these levels and watched it go down with a falling knife, and they all want to just get out at break even. So that's what I mean by a visual representation of market psychology. That's the psychology. They're going to be trying to get out at each level. So when it hits this level here, you can either take your profits and go, or just start moving your stops up. If it makes it through that level, then move the stop to that level. If it makes it through the next one, then move the stop to that level. So that's the way to do it. So it's a kind of a multi-part answer to avoiding the falling knife. The best way to avoid it is to get out before it starts falling. Last thing that I'm going to do here is I want to look at the dashboard real quick, and you can see there's everything today was pretty much up. The NASDAQ was the big winner. Regular NASDAQ 1.4. Bonds, 10-year went down 4.25, right where I said it was going to go for a while. 20-year went up. Dollar went up slightly. Gold went up. Oil went up. Crypto, Bitcoin went up to 85, almost 86. Crypto had a great day, but Bitcoin, I should say, had a great day today. And then over here on sectors, discretionary was the number one sector. So that's a aggressive sector. And technology is number 4. Communication services number 5. At the bottom is staples, which is a defensive sector. And you can see all the advancers. We've been looking at this for a couple of weeks. Last week this was real dark green, and then for a couple of days it was real dark red, and now it's back to dark green again. And down here, I want to point out, down here, the gambling index is one of the top 10 industry groups. Gambling. So on my website, I can go over here and look at the gambling and look at the stocks in the gambling industry, which is in the top 10 strongest ones for today. And these are the stocks that made the best moves today. So DraftKings was up 4% for the day. Penn National up 5%. This is just for the day. Gambling.com up 2.8. Trying to see that one. It's not in here. I'll look at that again in a minute. But if we want to look at it for the whole week, you can look at a week as well. And in this case, Penn National is, up almost 6% for the week. MGM is up there. Let's see what else. International gaming, technology. So those are all up there as well. Let's take a look at that one, GLPI. I just want to see what industry group it's in. GLPI. Oh, it's in specialty REITs. It's a REIT. Interesting. That's why it didn't appear in there. It's actually a specialty REIT. Just out of curiosity, I can go to the REITs. That's the real estate sector. Specialty REITs is down here. And if I bring up Geo Group, by the way, I talked about this even before the election. This is a company that manages prisons and detention centers for deportation. So you can see, if I look at the chart on this, you can see this is the election was back here. There's the election. That's what happened. And now it's starting to move up again right now. So that's pretty interesting. Let's see if GLPI is over here. There it is right there. So for the day, it's kind of in the middle of the pack. Yeah, but kind of in the middle of the pack. Let's look for the week. It's kind of near the top for the week. It's up 3.8% for the week. And for the day, it's up right here. No, it's only up 0.6%, but it's up nice for the week. Anyway, that's a way that you can use the website to figure out which industry groups are doing the best. The ones that are green are it's updated at the end of each week. Those are the ones that were in the top 10 last week. These are the ones in the bottom 10 last week. And the little box on the left-hand side tells you which stocks were in there. All right, so that's it for today. I hope that answered the question that I think the market might continue to rally for a little bit longer, but I'm not convinced. The rally is not really giving me a lot of clarity right now. So I'd be a little bit careful if it does go up and then starts to roll over at those levels that I mentioned before. Then I probably will get back into the inverse ETF, the SQQQ, which is right here. So you can see that I got in back here when the market started to roll over, got out when it crossed the trend line right here. And then I'm waiting to see if so this will pull back if the market rallies. And then if the market starts to roll over and go down, this is going to start to go up again. So that's what I'm watching. So that's where we're at. Anyway, thanks for watching. Have a great night. We'll see what the rest of the week brings. Tomorrow, I think we'll see the market reaction to the Fed meeting today. And don't know what that's going to be until we actually see it. So have a good evening. Stay safe out there. And please like and subscribe. Thanks again to everybody for getting me over at 1,000 subscribers. I appreciate it. And let me know if there's any symbols you want me to look at or anything else you want me to cover or anything in Technical Tuesday next week that you want me to cover. I don't have a plan yet for that. So have a nice evening, everyone, and take care.